In part 2, we also spend time to look at what differentiates somebody who is speculating the forex market from that who is investing in forex market. The main distinguishing characteristics are that the person who is an investor should be able to use margin or the money he or she borrowed from the broker prudently by not investing the whole margin at a time. The same thing, the person should have a sound technical knowledge, should have a sound fundamental knowledge, and so on. So part 3, we are going to look at what is forex trading. The buying and selling of currency on the foreign exchange or forex market on a margin. Again, we are hearing the word margin, with the intent to make profit either by taking investment or speculative approach. So it doesn't really matter. Forex trading, we have speculators. 95% of people speculate, or 99% actually speculate. Only a small number take forex trading as an investment. I used to speculate the market, but now I have learned, by the rope, to know that speculation or speculative approach will not return profit. So the first thing you need to have an understanding of what is a margin or loan. Why is it important to have an understanding of margin and loan? Margin and loan is the same thing. It's the money you borrowed from your broker to be investing in the stock market. We will look at it different ways of calculating your margin. We use my margin calculator in the previous lesson. Okay, let's keep on talking about the forex market. Because exchange rate fluctuates based on economic factors or fundamentals like unemployment rate, inflation, industrial production, trade balances, oils, and geographical events. These factors, they have impact on the value of currencies of different nations. In Namibia, we have Namibian dollars, which is tied to the South African rands. In US, they have the US dollars, the British pounds is there, the Japanese yens, the Swiss francs. All of this currency, they either appreciate or sometimes they depreciate or they fall in value. But the main thing that makes them to fall in values are the unemployment rates, inflation rate, industrial production, the trade balances, GDP, oil prices, or geopolitical events. Well, now the US is very, very important to the economy of the rest countries. So if their president, for example, Donald Trump, coughs or says something that is irrational, the market reacts to his statement. The same thing for other presidents of other countries. They also make some statements that can have impact on their own economy. So these factors influences whether a currency of one country will appreciate or depreciate against another country's currency. From the face value, forex trading looks like speculation. That is, if you buy with all your margin that your money can afford, I will take that again. From the face value, forex trading looks like speculation. That is, if you buy with all your money, or if you buy with all your margin that your money can afford. Yeah, margin is what your broker gives to you. So if you trade all your margin at once with all your money, then you are speculating. However, the strength of a currency symbol is a measure of the economic development of a country. So when the above indicators are bad, currency usually depreciate in value. And this in turn affects the cost of production, importing goods, and performance of stock market in general over a relatively long period of time. So when if you study this, the indicators, we call them indicators in statistics. When you know the indicators, the impact of the indicators, instead of putting the whole money you borrow from the broker into it, you take a little bit of it, you'll be able to return profit. Let's take a practical example here. Here is a situation where we say good economic numbers make currency to be strong. I use this as USD Japanese yen pair. The green is the USD, the red most probably will be Japanese yen. But let's focus on the USD. If the USD is strong, or is going strong day by day, month by month, it is doing so because the economy of US, the numbers are good, unemployment rates are low, more people are going into jobs, the wage rate is increasing, their GDP is increasing, people are happy, the sentiment is good, the manufacturers are hopeful, are very hopeful that they will manufacture more. You remember when Trump came into power in November of 2000, or when he was elected, he came into power in 2017. But immediately after his election, people began to be hopeful that he will change the economy of US. He will make America great again. People were putting hopes on him. The US dollar began to appreciate, became so strong. And it is strong based on economic number. If it is strong, it becomes very expensive to buy. If you are an investor, you buy the US currency against the Japanese yen, then you are buying it at a very expensive rate. Warren Buffett say you don't buy when a currency is strong, but you have to wait. You remember I gave an example of if you are buying into a company, you must wait, or you must be able to bid down the price. Warren Buffett say you must bid down the price, but in terms of currency, you are not the owner. Nobody owns a currency, for example, the US dollars. You can't say, okay, I will bid down the price. Do you agree to sell the US dollar for me at this price? No. You must wait for the currency to go down in value. It is called cheap price, markdown price, before you buy it again when it is going up. That is investing. Bad numbers or bad economic numbers, on the other hand, according to Warren Buffett, makes currency cheaper to buy. We have used two cases, the Japan economy versus the US, or the other way around, the US economy versus the Japan economy. If the US dollar is stronger than the Japanese yen, it is so because the economy of Japan is not as strong as that of US when you compare them. It means there are bad numbers coming out of the Japan economy. You have to buy Japan dollar or Japanese yen, not dollar. So this is one of the doctrines of Warren Buffett. which I'm going to repeat here. Warren Buffett's doctrine is saying a depressed stock market is likely to present us with significant advantage. For one thing, it tends to reduce the price at which entire companies become available. Well, I took this principle on face value. Literally, I believe in it, and I took it like this, and I replicate it for myself by saying a depressed forex market. This graph doesn't seem to be showing a depressed forex market. But if you to pair against Japanese yen, assuming this is US dollars, I pair this against the Japanese yen. The Japanese yen will become a depressed market. I said a depressed forex market is likely to present Daniel O'Hara with significant advantages. For one thing, it tends to reduce the price at which a currency pair becomes available for purchases. So if I want to purchase US dollars, I have to wait for the US dollars to go down. But as it is, assuming this is the currency, I would rather purchase Japanese yen. So good economic numbers are not friends of Warren Buffett. This is why I wrote this ebook, Faith in Bad Numbers. This is my guiding principles. So I have a well-established principles of what I will do before I invest in forex market. Even though I divide my fractal, so I divide my equity into fractals, still I have to wait for certain conditions to be ripe in the market, to be available in the market before I buy. The currency I'm buying into or I am investing into must be sufficiently depressed. It must be cheap. It must be marked down. So these are some of the principles which I will be teaching you. If you are following my investment, I'm not just teaching you for free, I'm teaching you so that you could follow my investment, my fractal fund management strategy. So Warren Buffett loved to buy when things are cheap. So if you want to succeed, you should also love how to buy currency pairs when they are cheap. So he believed in low risk principle. So the whole idea in investing is to buy into good businesses. So if the business does well, you do well in investing. You will do well too in your investing if you don't pay too much. So it's not a question of you divide your whole equity into fractals and the price is high. You invest that, you will lose the money. So he said that was true 25 years ago, and it will be true for the next 25 years, and so on. So, profit and growth and efficiency of using the money available to you are very, very paramount, or principles you should subscribe to. So a good margin of safety is required. You can turn $200 into $252 within about 12 months if you have good business to invest into. For example, my fractal management, fund management is a good business. If you put in $200, for example, you will return 152 in 12 months. So ironically, Warren Buffett recommends buying or investing into S&P 500 as a low-risk business. So why don't you learn how to invest $200 in S&P 500? S&P 500 is a good one, but when you buy slices of S&P 500, Dow Jones or Nasdaq at markdown price or prices, you are investing like Warren Buffett. You cannot be wrong over a relatively long time. I have covered some of these issues inside my ebook. So the proxies for American economy in Forex are USD versus Japanese yen, USD versus Swiss francs, and USD versus Canadian dollars. These are the currency which somehow imitate the American economy. You will be able to use or to understand the impact of fundamentals on Japanese yen or on Swiss francs or on Canadian dollars. So if you know how to interpret the monthly statistical releases by statistical agencies of these countries, you cannot go wrong with your investment if you keep your risk very low and if you don't buy too much, if you don't invest too much of your lot sizes. This is what this part is all about. I said if you want to trade currency, you don't just jump into it. You can start to follow my Fractal fund management. So let's look a little bit on why currency. Well, the currency market, it is the largest financial market on earth. You'll be hearing it, and I have come to see it. I have come to witness it myself. This is the largest financial market on earth. It is better than any business you can think of. It is true. I'm not trying to lure you. If you can control the risk, if you can control the money you borrowed from your broker, let me show you an example of what I mean by margin and the money you borrow from your broker. Okay, I'm taking you back into my trading chart. Don't worry about how rough it is. You will learn how to interpret the chart. But let's look at what we mean by margin. I have around $3,908 as my balance. My total equity is 811, and my margin is $165. My free margin is 3,646. What does it mean? My margin level is about 2,031%. What does it mean? It means that the money I borrowed from the broker, the margin, is just 165. I have an equity of well over 3,000. I did not go into the market with the entire 3,000. I took small parts of them. Let's look at the parts. I took a small part, which is just 0.11. So, one part of 0.11, the entire cost of this whole lot of parts is about 165. One of them is already returning profit. I know that all of them will return profit, but I did not push in the whole of my money. This is what we meant by margin loan. So to me, if the market goes worse, the amount I will sustain will be 165. If it does well for me, I could increase, or I could make about 165 or more. Currently, I have minus 97.23. One of them has returned good profit, small profit, but I have a total loss. By the time this loss increases to 165, I should close. I should close those trades. I know that they are not profitable. So this is what we mean by controlling the loan you borrowed or the margin you take from your broker. Make it small. Don't use your entire equity to start making investment, or to start making investment, at once. Though I invest in small parts, the same market gives me opportunity to return profit. So its average daily trading volume is more than 3.2 trillion. as compared with the New York Stock Exchange, which only has an average daily trading volume of 55 billion. So taking the whole currency market into consideration, the market has a size of 3.2 trillion. If you were to put all of the world's equity and future market together, their combined trading volume will only equal a quarter of the forex market. So the entire forex market is huge. So if you understand it, it is the best forex, it is the best investment you can be making. But if you want to return a quick profit out of it, it becomes speculative and dangerous. So why is size of the market important? The size is important because there are so many buyers and sellers that transaction prices are kept very low compared to buying stocks or commodities like gold, silver, oil, and so on. For example, I've just shown to you that I can make an investment in the forex market with even 165 US dollars. You can make even with $1. You can make with $10, but you cannot buy one single stock of a company with $1. You have to buy several of it. You must have enough money. People normally advise you should have about 100,000 and above for you to be able to buy stocks and return good profit. The same thing with commodities, gold and silver. But with forex, we have seen you can start your investment with as small as $200 and it will grow and return profit for you. So this is what we mean by currency trading. It is the buying of one currency against another country's currency. But we are not speculating. If you understand the fundamentals of each country, if you can look at the chart and do your analysis properly, I have shown you a chart already. I will keep on showing you charts. But the presentation is not on how to read your charts. That is meant for a different training environment. Thank you for listening to my part 3. You should look for part 4 on why fractal investment or what is fractal investment. Thank you for listening.